Let's get out to Michael Woolfolk, who's Senior Currency Strategist at the Bank of NY Mellon, who joins us now live from New York, and Simon Warner, Head of Macro Markets at AMP Capital, joining me here in the Sydney studio. Well, Michael, if I can start with you, since you're close to the action. The non-farm payrolls data came out. What was the reaction around you?
Well, certainly it was dollar negative in the sense that the market was looking for something a bit better. The results came in 100,000 worse than expected. Unemployment came in at 9.5%. The interesting thing, though, was that although you would have normally anticipated this as dollar negative, the market had already been selling dollars since the Asian Open. And one of the, I think, interesting things is Aussie yen had already declined 1%. After non-farm payrolls came out, the Dow Jones futures collapsed 150 points, and Aussie yen collapsed another 1.5%. It dragged the U.S. dollar down for a tick, but the dollar ended up continuing its rally. And we ascribe this more to a position adjustment ahead of the long weekend rather than a pure dollar rally. The dollar actually sunk against the yen.
Simon, give us your interpretation. The numbers are a lot weaker than many had expected. Had you anticipated a stronger number than what we saw?
No, I mean, we were looking for a weak number, a weak pattern at least. I mean, I think that there's two parts of it, isn't there? You don't expect to see the sort of $700,000 monthly job losses that we saw in Q1. Just unprecedented, never seen that kind of job shedding in the past. It's very natural that pulls back even from some sort of exhaustion factor on the part of firms. But if you look at the detail of the number, not only were a lot of jobs shed, but the work week also shrunk. Work week is important. We need to be looking at the total aggregate hours worked, total pay to employees. All that's shrinking at a very rapid rate in Q2. We're being boosted, obviously, by the fiscal policy on the other side, but the underlying fundamentals for the US economy still look very soft to me.
See, that's the real question, isn't it, Michael? If you look at this data set, do you look at it from a 6-month basis and say, well, a few months ago we had 6s and 7s and 5s printers, and now it's a 4. We had wanted the number to be in the 3s, but is the number that bad in the scheme of things? Is it just one monthly number that we could potentially look through?
Yeah, I think that you really have to look past this report and the last month's report and really look towards the second half of the year. The U.S. continues to lose a terrible number of jobs, particularly for this stage in the recession. You would expect to see less job losses. So losing 400,000, 500,000 jobs is quite significant and will certainly have an impact in terms of confidence as well as retail sales. We're nowhere near a recovery yet, but nonetheless, it may put some impetus behind the White House considering a second stimulus bill targeted at jobs creation.
What sort of stimulus bill are we talking about in terms of size? How much more money can the Fed spend?
Well, it's certainly the Congress's prerogative, and with the White House's guidance, perhaps something in the order of a third to half of the previous spending bill. But I mean, it really targeted at infrastructure. Rather than keeping people employed, we need to actually create new jobs. Our airport system, high-speed rail, the infrastructure within the Northeast, particularly our power grid, is woefully inadequate. So there are certainly projects that we could get started on, much like what we did back in the 1930s in response to the last great recession.
Simon, we have seen a lot of trades go on for some of the riskier plays. Is this a game changer, this number? Are we going to now see a return to the less risky currencies?
Yeah, look, to my mind, the risky pairs had gone a bit too far anyway. You look at Aussie on a TWI basis, it's around 30% from its lows. All equity markets have had good rallies. Bouncing in commodities, the commodity space in general has been reasonably strong, although the Aussie has outperformed commodities over the last 3 months or so. So I think that going into this number, there were lots of signs of exhaustion. Ahead of the summer anyway, people like to square up. But we were seeing momentum waning across in broad equity indices. Baltic Dry was rolling over a little bit. Upside momentum in base metals was waning. and to me, this number, not in itself is a game changer, because we know the economy is very weak. I don't think anyone was really expecting a sharp rebound in jobs growth at this point in the cycle. But I do feel as if it's one sort of pin in that balloon of a V-shaped recovery in the second half of the year. It's more of a reality check than a game changer to my mind.
There's been so many different forecasts for the Australian dollar direction. Michael, do you have a thought on whether it's run too hard at this 80 level and needs to go back a little bit lower?
Well, I'm definitely very bullish on the Aussie dollar. I think that the RBA is probably going to remain on hold for the time being. Commodity prices likely to remain elevated on continued demand, weak dollar. I see the Aussie dollar continuing to rise throughout this summer. And we could actually see 85 cents before U.S. Labor Day. The only thing that could get in the way of that, perhaps, is a dreadful earnings season in the U.S., which could push equities down, the dollar a bit higher, the U.S. dollar. But I think that's really an outlier at this stage.
Okay, interesting to hear there's still support. Thanks so much. Simon Warner joining me today from AMP Capital and Michael Woolfolk from Bank of NY Mellon.